We also have this key level down here. Price comes in, test the key level. We're actually waiting for the month of January, and as that is going on, we are already seeing that they've done an accumulation of liquidity down here. So January comes, the trend phase of the market begins, and then boom, that was the best time for you to take a trade. If you don't know how to avoid the forex manipulations, you'll find yourself picking lots of bad trade setups and entries that ultimately lose money. Maybe you're in that situation right now. Let me share with you what has been helping me in my own trading. Now, by putting together the 3 powerful keys I'll be sharing with you in this video, you will have a solid strategy that will not only preserve your capital by keeping you out of bad trades, but also it will help to maximize the profit potentials of your own trading strategy by putting you in trades where the odds are greatly stacked in your favor. In order to explain my point thoroughly and make it clear to you, I'll be giving examples using this big trade move I forecasted right here on this YouTube channel. Now, as a side note, if you are interested in knowing how to accurately forecast big moves like this one, I recommend you watch these 2 videos. Number 1, swing trading secrets, and then number 2, GBP Day swing trading setup idea. So now let's dive into the business of this lesson. Now, the number 1 key that I want to talk to you about that will help you in avoiding manipulations in forex trading is timing. Always include proper timing in your analysis. For every trading instrument, there are specific times of the year and times of the day when the most significant moves will take place. Now, when you therefore limit yourself to only finding trade setups and entries within that specific time window, you've increased your chances of having a profitable trade based on verifiable data. In working with time on the higher time frames, we use seasonal tendencies, while on the lower time frame we use time of the day. Now, on the lower time frame is where you look for entries. Let's see an example of how you can use this in your trading to avoid manipulation. Now, in this particular trade move that we forecasted, I uploaded a video on this channel on December 31st, and if you watch that video carefully, you would note that price was still down here as at that time. And if you watch the video to the end, at some point I said I was expecting the big move, that is this rally, to actually take place in the month of January. That is based on what data was showing me. And now what helped me, what guided my statements in that video was the fact that I was paying attention to what seasonality was actually showing. Now, right here on GBP, we see that in the month of January, it's expected that the pound should move upwards. Now, seasonality simply is looking at historical trend pattern and trying to use that to forecast what the trend of a particular instrument will most likely be at certain times of the year. Okay, so based on historical trend pattern of pound, we're expecting to see bullish month in, or bullish prices in the month of January. Now, on the other hand, it was expected that New Zealand dollar should move sideways. Now, that was the main reason why I was not expecting the big move to actually start taking place in the month of December, even when price was testing my key zone right here. So price was testing the key zone in the month of December, but I was not expecting the big move to happen in that month. So that guided me to ignore all this price action down here and wait for the month of January, when it is most likely for this pair to begin moving. Okay, so that is how you can use seasonality on the higher time frame, and it will guide you and keep you out of the manipulations. Okay, now on the lower time frame, if you're looking for entry, let me just do one example right here. Still the same move. After price consolidated down here, we began to move upwards. Okay, we began to move upwards, and the market began creating structure. All right, so we started making structures here. Our structure like that, and like this. So market began to make higher highs and higher lows. Okay, now as we started making higher highs and higher lows, a zone was created right here. Okay, there was this demand zone that was created right here, or you can call it another block level. That was a demand zone created there, and price was testing that. Now if you go down to the hourly, I will stop on the hourly time frame. I won't go down to any time frame that's lower than this. So right here, what I just want you to see is when the low of the day formed right here, giving us an opportunity to take an entry on this particular trade setup we forecasted. So after price came in and it started testing this 4-hour demand zone, we drew down here. Now when this test was taking place, this actually happened during the London session. Okay, so time of the day. All right, we're using time of the day right now to take our entry. So it is happening during the London session, and then you have this beautiful I like to call this inside out engulfing, but you can call it a simple engulfing candle. So this candlestick formed after price tested a demand zone during the London session. Now take note, when you're looking at this pair, this is actually GBP NZ day. So pound is most likely going to move during the London session because that is the session for that pair. Okay, for that instrument, for the pound, right? So it is most likely going to move during that time. So that makes London session a very good time to actually look for entry. Now think about it. If you were actually looking for entries here, say for instance you were looking at this, for those who are support and resistance traders, price came in, was testing this high right here, and price began to rally. Now this was an odd hour to take an entry. The reason is because this was happening during a time when the market is going to be slow, and it was actually happening outside the time window when we're expecting to see significant lows or highs or significant moves happen for this pair. So that actually would have guided you to stay away from taking entry here if you are a support resistance trader. But then waiting for London session, we saw this move down, which clears out the slow for liquidity and then dips into a demand zone, and that made this a very good entry looking at the candlestick pattern. So that could have guided you and kept you away from the manipulation. Okay, so moving on now, the second key that I want to talk about that will help you in avoiding the manipulation is key levels. Always consider key zones that matters to the large institutions. On a personal level, these zones can either be a price range with evidence of large, long or short entries by the large institutions, like the real demand or supply zone that I teach right here on this channel. The key zones that I also look for can also be levels where the big institutions have bad trades in their books and are looking to bail out of them. Okay, like the bank offloading zone or dealers offloading zone, which I have not yet taught on this channel, but that is included in my own training course. And then finally, the zone can also be a liquidity pool where we can anticipate accumulation or distribution of orders by the big institutions. If you take a look, for instance, on the daily chart right here, as price was moving down into that zone, you will find that there was a double bottom right here, which is support and resistance theory, right? So price came in, tested that double bottom level, which is going to be considered as support level in the cycle of retail traders. So the question to ask is this level a level that matters to the big institutions? Does this price range matter to the big institutions? That is the question to ask, all right? Because those levels that matter to the big institutions are where you're going to see the most significant move originate from. Okay, because at the end of the day, it is the big institutions that are behind the manipulation as they seek liquidity to get in and out of their large trades. So think about it. For the uninformed traders, when they see the breakdown of price breaking past this level of what they call support, what do you think is going to come into their mind? They're going to rush in to start selling this move, right? So they're going to be selling because price had just broken support, and it means that from that point on we should start seeing drop down. And if you go into the intraday, you're definitely going to see a retest of that level, and then price now made an attempt to drop down, right? So because the uninformed traders, they are not aware that down here below this area of what they call support, but what we call liquidity pool, below this area is a real demand zone, a zone where there is actual evidence that the big institutions were actually accumulating long positions in the past. And so when price comes into that level, it is most likely that they are going to accumulate more orders, or at the very least defend that position. Okay, but to the uninformed trader, there is nothing there, right? And so they will be making the mistake of selling because they think price just broke support, and so they were making a mistake of selling, but they are selling into the demand area of the large institutions. So the third key that I want to share with you that will help you in avoiding forex manipulation is what I call the institutional market structure. When you understand and know how to use to your own advantage the institutional market structure, otherwise known as the forex master pattern, it's going to help you a lot to avoid the manipulations, because then you're going to be seeing the market through the actions of the institutions, how they operate in the market space. So the institutional market structure consists of 4 phases. Number 1 is the accumulation and manipulation trend phase, and then distribution. Now let's make a drawing of what the institutional market structure would look like. Now assuming the big institutions want to be buyers in the market, now because they're trading large volume, they're going to need liquidity. Okay, so if they are going to be buyers, they will definitely need sell side liquidity to be able to establish those buy positions. Okay, so the first thing is to create liquidity. So this is what we call the accumulation phase. Okay, so the accumulation phase is sometimes an old low in the past or an old high. So in this case, if they are looking to buy, they need to create, they need the availability of sell side liquidity. So it's going to be an old low. Okay, so it's either going to be an old low or a consolidation. So to give people that false perspective that support is forming. Okay, so there's support right there. Then the next phase is going to be the manipulation, where they take price below the support. Okay, and then what the uninformed trader will say is price has broken support, and then they're going to rush in to start to sell. Now as they're rushing to sell, guess who is buying it up? The big institutions are buying that up. Okay, so as they're rushing to sell, the big institutions will be using that sell side liquidity to establish their buy position. Okay, so that is what we call the manipulation phase. Then after the manipulation phase, price will go into the trend phase. Okay, where price begins to trend. All right, now within this trend phase, you can also have reaccumulation going on. All right, so reaccumulation is when they're going to be accumulating more positions along the way. So sometimes within this market structure here, you might see something like this. Okay, where an old low, they created false low, like what we saw in that example in GBP and ZD. I'll still show you that. So and then they will take it back up, continue the trend until they get to a point where they want to distribute. Okay, and what happened down here will also take place again. So in case the big institutions are looking to sell, they're going to do this exact same thing on this opposite side, right? So what happens is they will create that false idea that there is resistance right here. So lots of people are seeing this. There are people who are going to believe that and begin to sell the resistance, put their stop loss above there, and the stop loss is going to be buy side liquidity. Then the big institutions manipulate price beyond that point. So you already have some buy side liquidity up there because of the early sellers in this market, right? But when you now have price break through the point of resistance like this, you're going to have more buy side liquidity coming in because people are going to say resistance have been broken, and so it's going to go up and higher, and so they're rushing to buy more. So this means more buy side liquidity coming into the market, and then that is when the big institution steps in and sells or accumulate a sell position using those buy positions, and then the market will move into the trend phase. And within that trend phase, again, you're going to have reaccumulation, or some people might call it redistribution. So you might have that, something like this, and then it goes on and on, and so the cycle repeats itself, and so on and so forth. So this is the institutional market structure. So you need to have a very good understanding of it if you want to avoid the manipulations that actually occur due to the accumulation of liquidity and grabbing of liquidity and all of that stuff by the big institutions. Okay, so let me show you an example of this in the chart. So looking at an example of this in the chart, we see first of all there was an old low created here. Okay, so there was this old low created here, and price came into that point, and what happened again? Price bounced off from that level. Now what do you think would be going on in the minds of traders when price came into that level again and bounced off here? They're going to say support is holding. Okay, and so they're going to start buying. Their traders were going to start buying the moment this candle closes, and their stop loss will go below the level. Okay, now if you are a buy trader, in order to get out of a buy trade, you need to sell. Okay, so these people who are entering buy positions here, their orders or their stop loss orders are in form of sell side liquidity. Okay, so this is going to be your accumulation phase. Under here there is sell side liquidity that is being accumulated. Now price breaks through that level. Okay, price breaks through that level. Now there's going to be more sell side liquidity coming to the market because people are going to say price has broken a very strong support, and it's going to be all over the news because these kinds of levels will be reported since they are multi-month lows, you know, and stuff like that. So they're going to say support has been broken, and so people are going to take that as signal to want to sell this pair. Okay, which means more sell side liquidity coming into the market at that point. Okay, so more sell side liquidity coming in from willing sellers. These ones were forced sellers because they were not actually into the market to sell. They were here to buy, but in order to get out of a buy trade, it's either they're going to get out when price hit their stop loss or hit their TP. But either way, for them to get out of a buy trade, they need to sell off their positions. Okay, so but they were forced into a sell position when price hit their stop loss. All right, so there were forced sellers, and then there were willing sellers who came in to sell the market when price broke down the support level. Okay, so now this phase, this swing down is what you call your manipulation. So this is what they use to accumulate the sell side liquidity, and this leg down will be the manipulation. Now on the lower time frame, since we are looking to catch the move, when we drop down to the 4-hour chart, we are then going to see very clearly the trend phase of the market. So looking at the market here, it becomes much more clearer. So you can see how price, after getting into here, we had this very tight consolidation. Price was just moving sideways, and then we had the breakout here. Okay, we had the breakout. So from here, this point, price started going into the trend phase. So in order for you to avoid the manipulations and get into the best part of the move where the odds are stacked in your favor to make profit, you should avoid the accumulation phase and then the manipulation phase, and only focus on trading when the trend phase starts. So when the trend phase started here, this would have been a very good entry. That was the first entry, and you can see the market spent very little time here before it started rallying off again. Okay, so there was another opportunity here. Price comes in into demand again. Okay, and then look at this very small time that is spent here before rallying. Now while I was drawing what the institutional market structure looks like, I did say that within the trend phase you can also have reaccumulation going on. Okay, so what we had here was a reaccumulation that was actually playing out. So they were reaccumulating long positions. They were buying here, okay, just like they were buying here also. This was also some form of reaccumulation. So here they were actually buying here, and then they intentionally created this sell side liquidity area around the level where they're buying in order for them to get into more buy side position. And look at how price did rally and continued higher. Okay, now when you watch the video where I made the forecast for this particular pair, now I was saying that once price reacts from this point, or maybe from the zone below, but once price begins to move, the next point we're expecting price to reach for would be above these highs. Now the reason was because above this high would be buy side liquidity, and availability of buy side liquidity for the big traders to transfer these buy side trades they have in order for them to close in profit. Because if they are buying here, what they'll need to sell to willing buyers. Okay, they need to sell off all they've accumulated down here as price is moving higher. They need to sell all of that to willing buyers in order for them to close in profit. So for them to do that, they are going to use existing areas where buy side liquidity is most likely going to come into the market, or they're going to create squeeze. Okay, so in case there was no old high like this here we have triple top, so this is going to draw a lot of attention. So but in case there was nothing like this, then we would have been expecting to see a squeeze, okay, where volatility is going to drop, but then you're going to have people calling this top resistance, right? And so when price breaks through, just like as I was showing in the drawing, a lot of people will start coming in to buy, and then that will give them the opportunity to get out of all these buy trades that they've accumulated along the way when price was actually moving upwards. But now they actually have this triple top right here. There's a triple top formation, okay, which is considered to be a very strong level of resistance. So that is the reason why we're expecting to see price trade into this level, and it's just remaining a couple of pips for you to get there, right? When price comes in here, if it breaks through this point, or if it gives it a first test then retraces, people are going to say, well, resistance is holding, and they're going to start selling the move. If they start selling, they put their stop loss up there, and the stop loss is going to be in the form of buy side liquidity. And then that is what I'm thinking. If they now take the price above that point, the uninformed trader are going to say, oh, now price has broken resistance. So what do? They will come in to be buyers. Okay, so that gives the big sellers or the big institutions the opportunity to even sell more of what they've accumulated down here, and then that will give them opportunity to close in profit. Okay, so that is how the knowledge of the institutional market structure helped me to analyze this. And when you understand the forex master pattern or the institutional market structure, then you will know that the best time for you to trade would be to avoid all of this, avoid this manipulation and all of that. You already understand what's going on here, and then you know that the best time to trade would be in the trend phase. As price is making the move towards a point of distribution. So when you have all these different tools together, you can see how they came together to help us to avoid manipulation, see the market more clearly, avoid those areas where people are blowing up account, people are losing money. Okay, so when you use time, we already know that January will be the most likely time for this big rally to actually happen. And then we also have this key level down here. Price comes in, test the key level. We're actually waiting for the month of January, and as that is going on, we are already seeing that they've done an accumulation of liquidity down here. They've taken that liquidity, okay, and now the next thing is to expect the trend phase of the market to begin. So January comes, the trend phase of the market begins, and then boom, that was the best time for you to take your trades. That is how you can avoid the manipulations, and at the same time find great trade setup where the odds of making profit are stacked in your favor, right? So if you enjoyed this video, guys, please like, share, and subscribe to the channel. And you can leave a comment down below. I will see you in the next video. Cheers.